Good morning, everyone. Welcome to our Mornings on Main, our first one for 2021. Hope everybody had a good holiday and a happy new year. Just as we're waiting for other folks to get on board, let me advance my slide. Just want to remind folks that you're coming in to this webinar in the listen-only mode. You're automatically muted when you come in. You can change your audio functionality between your computer and your phone. If for some reason you're having some technical difficulties, you can toggle back and forth between that, and those instructions or buttons are within your control panel on your screen. We want to keep this as interactive as possible. So we've got a great speaker today, Bill Emmons, and we want to hear your guys' questions after his presentation. So there is a question box that we ask you to submit those questions, and you can do that anytime throughout the presentation. And then when we get to the end of Bill's presentation, I'll moderate through those questions and we'll have a discussion afterwards. So please feel free to do that as we go through. If for some reason we run out of time and don't get to all the questions, my email address is there on the screen for any follow-up. And then just reminding everybody that all of our Mornings on Main webinars are recorded, and you can go back and watch any of these from our archive. In fact, I've had Main Street communities use some of these videos for their committee trainings. Had a friend text me a couple weeks ago and say, hey, you're at our training today for our Economic Vitality Committee. They were watching one of the previous webinars as a committee to provide education for that committee. So I thought that was a cool use of these services, and of course, one of the benefits of us going virtual. All right, Gail, are we ready?
We are ready. Thank you, Keith. Good morning, everyone. And the exciting thing is because being able to do this, we've even had other states, other coordinating programs, Main Street local programs around the state join us, and also go back and take our webinars as well. So welcome, William. We may be talking all across, the U.S. to different people. So great to have you this morning. So William or Bill, do you like to be called Bill?
Bill is great.
Bill is great. Well, I know you as Bill because one of our board members knows you more than we do, but Bill had just recently joined our advisory committee here at Missouri Main Street Connection. So we're really excited that Bill has joined us with all of his wealth of information. It's really going to help move Missouri Main Street forward as well. So Bill Emmons is the lead banking economist in supervision at the Federal Reserve Bank of St. Louis. He co-founded and served as the lead economist in the Center for Household Financial Stability from 2013 to 2020. So welcome to you, Bill, and we're really excited for you to get started, and we hear about what our economy looks like into the future.
Thank you very much, Gayla and Keith. Yeah, it's a very great privilege for me to be speaking with everyone today. And as Gayla said, I'm very excited about learning more about Missouri Main Street as an organization and what's going on around the state. So I want to take this opportunity as we enter 2021 to characterize kind of where we are and where we're headed. And of course, it's always difficult to look very far into the future, but never more so than now. There's so much uncertainty facing individuals, businesses, bodies like the Federal Reserve. It's very, very difficult to look forward. So I'll just give you my views, and I want to emphasize these are only my views, not necessarily those of President Jim Bullard, for example, of the St. Louis Fed, or anybody else around the Federal Reserve System. Okay, so what I want to do is take this in 3 steps. First, at a broad level, at the level of the U.S. economy as a whole, how does it look in 2021? And I would characterize it as, and this is sort of the Fed view, but I'd say also held in the private sector generally, that there's cautious optimism. So, it's going to be a very, very challenging first half of the year. I just heard before we started an economic report out this morning. You'll probably be hearing more about it today. It's a preview report for the very important employment report that comes out on Friday. This is a private sector estimate that came out this morning that said that employment actually declined in December in the nation. So that would be the first time since the very early part of the year. And not a good sign that we're losing momentum, and I have more to say about that. So the first half of 2021 at least looks to be very challenging. Some people are even talking about a double-dip recession in the probably in the first quarter of this year. So on the other hand, we're looking forward to widespread vaccine deployment by mid to late 2021. And as Chairman Powell of the Fed and many others have said from the very beginning, the economy depends critically on getting the COVID situation under control. And only then can we really talk about getting back to economic normality. So that's the first step, kind of looking at the national picture, especially the job market. Secondly, now zooming in a little bit, what I'm going to call the Main Street economy, consisting of households and small businesses especially. On the household front, it's been a very strange year, as you all know. We've had a very wide range of household outcomes. What I would characterize all the way from the good through the bad to the very ugly. There's been some really great deal of distress among a lot of households, but at the same time, other families are saving a lot of money. They've held on to their jobs, good increases in stock prices, house prices. So very diverse picture there. In terms of small businesses, I think it's safe to say that most small businesses were hit pretty hard, and many are still suffering. So this is in comparison to larger businesses especially, but also contrasting with that outcome for households. And a lot of these distinctions have to do with how the support came in through the CARES Act and other programs. And then I want to also, and kind of weave into this, a little bit more information specifically to Missouri, the Missouri Main Street economy. And I was asking Gail and Keith beforehand, and I'd be interested in anybody who has thoughts on this. My impression is that despite all of the fears that we had early in the year that this was going to be, just a wipeout because of the COVID situation, I think there's evidence there's been a lot of resilience. Certainly businesses, as I said, have been hit. Some households are struggling mightily, but there's also signs of resilience, optimism looking into this year and beyond. Now, I think, again, bears repeating that the key factor that made this year different than the financial crisis, the 2008 period, 2009, is that this time we had very rapid, very large scale government support coming in for households and for businesses. The other major difference that we at the Fed especially have been watching is that the financial system has been much stronger, much steadier this time. So we didn't have, and there was a fear back in March that if we had another financial upset or even a financial crisis, that would of course make everything much worse, and that didn't happen. So cross our fingers that we will not see anything like that even in 2021. So I'm going to suggest that the challenge for 2021, of course, is getting past COVID. But then as we look toward the post-COVID economy, how can Missouri Main Streets prosper as we go back to the situation that we had even before of really a relatively slow growth, and in some parts of our state, even declining population. And of course, it's not unique to Missouri. That's true generally in the Midwest. And I recently wrote an article that'll be coming out very soon. It's also true at the nation as a whole. As far as I can tell, 2020 will be the slowest population growth for the nation in the history of the country, outside of periods of wartime when we were moving soldiers around. So those are the three steps that I want to try to take it. And as Keith and Gail mentioned, please, if you have questions as we go, maybe put those in the chat and we can talk about those later. So first step, U.S. economy for 2021, cautious optimism. So what does that mean? Well, back in the middle part of the year, as you may remember, there was a lot of discussion of a so-called V-shaped recovery. And I think this picture shows it perfectly. So the solid line is the amount of employment. These are total number of people employed. And this picture uses the average level in 2019 as the base and just sets that equal to 100, because I'm going to use some other series for comparisons. So this is just how these charts are set up. And of course, We had a huge decline early in the year in employment, more than 10%, as you can see there, from 100 down to below 90. Then in the third quarter, a big pickup, and it looked like if we could continue that momentum through the fourth quarter, we might get right back up to that dashed line, which was the trend, or the path we were on before, maybe as soon as the fourth quarter or first quarter of 2021. So that's just on the basis of a simple extrapolation of the growth rate from the second quarter to the third quarter. However, that's not what happened. This is a forecast now. The blue dashed line is the most recent forecast from an organization called IHS Markit. That is based on the macroeconomics advisory firm here in St. Louis, and they were taken over by IHS Markit, which subsequently was bought by S&P. So this is a very, very reputable firm. Their view is that the employment V is no longer. It looks much more subdued, and the path out through the end of even 2021 will not take us back up to that pre-existing employment trend. Well, what happened? Well, if you look at the monthly numbers, in fact, we had this collapse in April, very strong rebounds in May and June, and then we sort of ran out of gas. It looked like growth really slowed down after June. And every single month, there's been a slowdown in the number of jobs created. And as I said, the report that came out this morning, the preview for the Friday's government report, suggests that that December number could be flat, or it could even be a negative number. So that does not look like a V anymore. If you look at the Missouri numbers, we very much look like the rest of the nation. Huge decline in April, very sharp rebound in May and June, and then again, sort of ran out of gas. The jobs recovery really slowed down. The unemployment numbers look a little better. So this is the fraction of the labor force that is declaring itself unemployed, that is, they're actively searching for work. Big increase in the unemployment rate nationwide in Missouri in April, and then declines in every month after that. But I think you can also see, and again, the blue dashed line is that forecast looking forward, that we're not going to get back down to that 4%, or even in the case of Missouri, 3% type unemployment anytime real soon. So what happened? Well, probably a combination of things. The immediate bounce back was simply removing the constraints on growth, both imposed lockdowns, but also really just the fear and uncertainty that people felt. So there was some amount of that could snap back fairly quickly. But I think the other really important thing is that the huge government support and the CARES Act really started to fade after June and July. July was the end of the supplemental unemployment insurance payments, for example. And so you really see the importance of that in supporting household incomes. And that, I think, is the reason that we saw the softening later in 2020. And by the same token, the second package, the one that was most recently enacted, somewhat smaller than the CARES Act, but similar in many respects. And so that's probably our best hope for avoiding this double dip recession, is that this recent package will start to support households and businesses in the very near future. All of this, as we sort of build a bridge, we try to get ourselves through the period where we're still battling COVID and trying to get the vaccine deployment to take us back to a safe place, if you will. So if you've been following this discussion, you probably have heard this idea of scarring or permanent damage. Is there a risk, and we have seen it in past recessions, is there a risk that what's happening can't just be immediately fixed, can't be reversed? And a very important version of this is people dropping out of the labor market and then just not coming back, either because they have several reasons. People talk about, losing contact with potential employers, with job networks, becoming very discouraged, people feeling their skills are out of date. And there is some evidence of that, even in 2020, that the number of people who are either working or actively looking for work, that's the labor force, there's been a pretty noticeable decline, both in Missouri and in the US. So this is, unfortunately, some evidence that we may have some scarring, that people will not be able to or willing to come back into the job market once we get into the post-COVID environment. On the business side, obviously businesses, especially smaller businesses that go out of operation, some of those will be able to come back, but some won't. At the same time, there are a lot of people starting new businesses, so that's also a hopeful sign. Consumer spending, of course, driven by employment, but also then by the government support, looked early on like maybe it would be a V-shaped recovery. And this is the same exercise. If you extrapolate that Q2 to Q3 rate, you get back to the pre-COVID trend, by the end of 2020. But you shouldn't be too surprised, I guess, that when you look at the monthly numbers, it looks more like that employment picture. After the rapid bounce back in May and June, growth definitely slowed down. And so this also is consistent with a lot of loss of momentum late in the year as the CARES Act had expired in some respects and was losing a lot of its effect. So where do we stand with COVID? This is a picture. It's very difficult to forecast where COVID is headed in terms of cases, hospitalizations, and deaths. This is a picture of the daily deaths, smoothed out a little bit. A peak back in the early part of the year, then those numbers came down, but then late in the year, of course, numbers went up again. And that's, of course, also a factor in the economy slowing down, people starting to withdraw or pull back again, and also some closures mandated in some locations. So the solid line takes us up to where we are right now, and then the dashed lines are various forecasts depending on scenarios. For example, universal mask mandate is the green line. That would probably cause these deaths to go down most rapidly. At the other extreme, the red-orange line is if we in fact reduce precautions. That would probably allow deaths to go back up over 5,000 per day, which is a stunning number. We're now in the 2,500 to 3,000 range on a 7-day moving average basis. Just enormous human tragedy if that's what happens. In either case, though, the point of this picture is that it looks like, at this moment, it looks like the peak could be in January, could be in February of this year. And as we are moving to deploy the vaccine, that will help us bring those deaths down, allow people to re-engage, and as we get into the later part of the year, hopefully return to something like normality. So in terms of the overall national economy, as I said, it's really driven by COVID. If we can get this under control, the fiscal support was very important that was passed recently. That will hopefully bridge us into that later part of the year. But if not, if that was not sufficient, we have to be realistic. There is a chance that we will be looking at a double-dip recession, that we will have declines in employment and spending early in 2021. So that's what I mean. It's going to be a very, very challenging first half of the year. So what's happening on Main Street? And as I said, I define that to mean households and small businesses. Well, the support provided in the CARES Act primarily for households was truly, truly unprecedented. This is a picture that shows on a per capita basis, so numbers divided by the total population, how much did unemployment insurance plus pandemic relief, for example, the one-time what turned out to be now two-time payments, how much did that really amount to per person? And you can see in 2020, the sum total of those cash payments tripled versus their level in 2019. And of course, in 2019, it was all unemployment insurance. In 2021, that's coming down quite a bit, but still remains higher than it was in 2019. So this is really the big story. Well, one of the big stories for households is tremendous cash support through unemployment insurance and these special pandemic relief programs. The other big story, I would say, is the resilience, the number of people who have been able to continue to work either from home or in modified ways in physical face-to-face settings. At the same time, speaking to this broad range of outcomes, we also know, many of us are I'm sure, either personally seeing it, suffering it, or no people who are facing lots of challenges, lots of stress. So these, and I have a couple of pictures from this, these are surveys, new surveys done by the census in 2020, looking at households, but also at businesses, asking basically, how are you doing? What sorts of things are most challenging to you? So here are just a few of these measures. And this is specifically households from Missouri reporting, for example, on the top line, difficulty paying usual expenses. So this number suggests that 35%, 1 out of 3 households in Missouri is having difficulty paying their usual expenses. So this is really an extraordinary level of distress. And in particular, another question asked, have you lost income from a job? And 25%, 1 in 4 Missouri households has lost income from a job interruption. And also 1 in 10 Missouri households is suffering food insecurity, having some difficulty getting food on the table, at least some of the time. And somewhere between 5 and 10% of Missouri households report that they are concerned about losing their housing, being evicted or foreclosed. Now, this has been one of the features of the CARES Act and some local initiatives was to reduce some of the pressure, especially on housing, by slowing down or actually even eliminating evictions and foreclosures. You probably have seen there's a lot of concern about when these particular restrictions expire, whether we might face a surge of people who in fact do end up losing their housing. So that is another part of this very challenging first half of the year. How do we get through until we can get people back in a situation where they can maintain their financial stability? Very much related, those were more economic measures, but of course we know it's very related to the health situation. And one dimension on which we've seen very, very different outcomes is across race and ethnicity. These are some numbers from the Centers for Disease Control up through the end of November, and these are all numbers compared to white families, white non-Hispanic families. So the columns indicate first American Indian, Alaska Native people in the first column of numbers, then Asian non-Hispanic people, third column is Black or African American, and the fourth is Hispanic or Latino persons. And in each case, these numbers represent, relative to non-Hispanic white individuals, what has been the experience of each of these groups. First row is the number of cases of COVID, the second is the number of hospitalizations related to COVID, and third, the deaths. And in virtually every case, you can see those are greater than 1, which is to say higher levels for these groups in how COVID has affected them. And of course, most tragically, that last line, 2.5 times more likely for American Indian or Alaska Native people to die from COVID versus whites. And any death, of course, is a tragedy. The fact that it's concentrated in some of these groups, some, not all, also facing economic disadvantage. And I think this, a lot of people are concerned that this is going to be one of the legacies, is that vulnerable individuals, vulnerable communities have been hit so hard by the health impacts as well as the economic impacts. And again, the economic or financial, very clear differences. These are the 4 major groups used in lots of statistics. Non-Hispanic white, non-Hispanic Black, Hispanic can be of any race, and all others, which includes, for example, people of Asian descent or people who report more than one race or ethnicity. The increase in the unemployment rate among white individuals, 2.7 percentage points. That is, the unemployment rate's that much higher in November this year, or rather 2020, than it was the year before, versus 4.7, 4.2, 4.1 percentage points higher for those other groups. So clear distinction there. Then the last column is the wealth. How much net worth, assets minus liabilities, did families of various races and ethnicities report at the end of the third quarter versus a year ago? And again, white, and in this case, the all others group had fairly strong increases in wealth, whereas Black and Hispanic families were either small increases or declines. So these these again are potentially a little bit longer lasting effects that we're going to be seeing as we come out of COVID. Turning to small businesses, I wanted to back up a little bit, and even before COVID, I think you could make the argument that a lot of small businesses were having some difficulties. This is employment, and here the comparison starts in 2015. So the level of employment in 3 different categories of businesses: large, with 500 or more employees; medium, in the 50 to 499, and then small businesses between 1 and 400, or 1 and 49 employees. You see the small business, and to a lesser extent the medium-sized businesses, were lagging even before we hit COVID, and then the huge shock caused a big decline in employment at all those levels. All of those types of firms have bounced back, but still, this is saying that the small business level of employment, total employment in small businesses, is a little bit lower today than it was even back in 2015. So this is some vulnerability that COVID has really exacerbated. One of the major programs of the CARES Act, and I think by most people's account has been successful, is the Paycheck Protection Program, the PPP. These were very low interest and in fact forgivable loans to small businesses that could be used for a number of purposes, including paying employees. So this is based on another census survey of small businesses, asking, in this case specifically, small businesses in Missouri, first, had they applied for a PPP loan, that's the red line, and secondly, have they received the proceeds? And as you can see, there's a little bit of a delay early on between application and receiving, but fairly soon, by May and June, roughly 80% of small businesses in Missouri report that they had received PPP loans. So I think this has been part of the resilience that we've seen. And this is, of course, why there was so much support for another version or another round of PPP loans, which are in the recently passed package. So that will be coming very soon. And it's going to be an important part of getting us through this early part of 2021. So I've kind of mentioned some Missouri numbers already, but I'm going to turn a little bit more specifically to Missouri and talk about Missouri Main Streets. I think this resilience is surprising. Maybe it shouldn't be so surprising that people are resilient. Businesses and households can be resilient in the face of some really challenging circumstances. But I want to ask also, once we get through this, where are we going to find our growth momentum? And I think there's something we should all be thinking about is what does that post-COVID world look like? And to some extent, it's going to be the world we knew before, of course. And one important aspect of that is our demographics. I just want to throw some numbers out in that regard. So usually, household income declines in a recession. Here is a picture that shows 3 recessions, including the current one, going back to 2000. And the line shows the growth from a year ago in real per capita personal income. That is adjusted for inflation, adjusted for the number of people in your family. How much income do you have? And the gray shaded areas are recessions. And in the 2001 as well as the 2008 recession, this income measure goes down. The year-over-year change is negative. Not very negative in 2001, but very deeply negative after 2008-9, even into 2010. So that really hit households very hard. And that is the classic pattern. That's what recessions do. Now look at the current one, which I have circled. Very, very different. Household income, in fact, is going to be very much higher in 2020 than not just in previous recessions, but in any previous year over the last 20. So this is an extraordinarily different experience, entirely due to the CARES Act support. And I think we should really be happy. I mean, there's a lot of discussion about our political system not working, but this is an example of it did work. We got this package put together in March and April, and it provided a huge boost to household incomes. Not universal, but on average, it really has made a huge, huge difference. And there you can see it. This is the same information now, just in the levels. So it's on the order of $3,000 or $4,000, consistent with the picture that I showed you before. Through unemployment insurance and the extra unemployment payments and the one-time, now two-time payments that will be coming, we've put a floor under household income to try to reduce the amount of suffering that individuals are facing. But also, of course, that's how we support business, in having people have income that they can spend. Small businesses in that small business survey are asked a number of questions, and one I think that's very insightful is just a very broad, open-ended question about overall sentiment. How are you as a business person, how are you feeling about your business climate? And I just wanted to show here that, of course, this is across the entire country, but there are some differences. Missouri is the red line, so this is showing from the beginning of this survey back in May through the end of December, there's been a little bit of improvement. So the scale here is from 0, not feeling any negative pandemic effects on business, down to -0.1, which is the most extreme measure. So the upward movement shows there's been a little bit of improvement, but the fact that we're still at about -0.4 suggests that most Missouri small businesses still feel significant negative effects from the pandemic. This is a little less negative than for the entire US and quite a bit less negative than for businesses in, for example, in Illinois, one of our neighbors. So, as I said, even before COVID, we knew that we were kind of in a different world looking forward, in that our population growth is slowing, not just in Missouri, but in the Midwest generally. So here are a few of our neighbor states. And again, we can, unfortunately point to Illinois, that's a state that's facing this, what for many people is still in the future, but it is already happening in Illinois. The population of Illinois is declining. The workforce in Illinois is declining, which of course makes the fiscal situation more difficult. The tax base is under a great deal of pressure. It makes the business climate more difficult when you have weak or even declining population growth. But look at, for example, Kansas. Also, the population of Kansas is basically flat over the last 5 years. This is even before COVID. And we know that the COVID episode itself is raising death rates. It's actually lowering birth rates too. And there's also somewhat pre-existing, but it's slowed down net immigration. So population growth as a whole is going to be slower, certainly in 2020, probably in 2021, than it has been in the past. Even a fast grower like Arkansas is definitely showing some slowing over the last few years. So I think it's important because the way you think about business, or the way you think about local economic growth or local economic development, depends on whether it's a very fast growing, slow growing, or even declining population area. As I said, this is happening across the nation, especially in the Midwest. This is the growth rate of the Missouri population in red, going back a number of decades. And certainly since the early 1990s, there's been a slowing. In virtually every period, the Missouri population growth has been a bit below the US population growth. True of the other Midwestern states too. So here, this is from a website on the St. Louis Fed website. I've got the address up there in the blue bar. It's called GeoFred, and there's a whole bunch of information you can get at the county level. This one is population growth. So I'll just show you a couple of years, the last 3 years. So this is the county by county, the change in percent of resident population. This is from 2016 to 2017. So I think the color key is down in the bottom. I hope it's intuitive, kind of a stoplight, red, yellow, green scheme. The dark red those are counties that lost more than 1% of their population in that single year. Then the yellow is in the middle, positive, but less than 1%. and then 2 shades of green, the dark green being more than 2% growth in a single year. So in fact, there was just one Missouri county in 2017 that grew that fast. There were a few that grew in that lighter shade of green, and then a fair number of yellows. I think I would, of course, all of you I'm sure are aware, big differences across our state in the major metro, the St. Louis, Kansas City areas, but also in central and southwestern Missouri. There are more counties where population is growing. The Boot Heel is an area where population is declining very rapidly, but also across the northern tier of counties, there's a lot of instances of population decline. So that's 2016 to 17. Here's the next year, a little bit faster overall, looks like. Also, I should point out, look at some of our neighbors. The counties in Illinois, most counties in Illinois are losing population, some of them very rapid rates of more than 1% per year. And then the most recent numbers we have, 2018 to 19. Again, some strong growth in the suburban St. Louis area, or exurban areas, but also central, southwestern Missouri, and in the Kansas City area. So you probably know some of those counties, not all of them. Let me zoom in a little bit and show you first in the northern tier of states. This is just for 2018-19. So you have side-by-side counties, you know, for example, Lincoln and Warren counties over on the exurbs of St. Louis, growing 2.5% per year. And then right next door, Pike County losing 1% of its population. And then some other counties with pretty significant outflows of people. And I think it's a combination both of low birth rates, which are true in a lot of places, but also maybe some net out migration. And in the southern tier of states, one of the fastest growing counties, in fact, I think I'll show you a picture of the long-term trends, Christian County, just near Springfield, still very rapid population growth, and a few others also more than 1%. So here's all of the counties in Missouri. So I think that, you know, maybe it's a surprise, maybe it shouldn't be. There's a huge range. There's a lot of variety, a lot of variation across the state in the growth rates. This is now looking over a 40-year period. The states at the top, shown here, there were 17 counties that have more than doubled their populations since 1970. So that's very much in the ballpark with you know, the Sun Belt sort of high growth parts of the country. And the names are listed there. As I said, Christian County, St. Charles County, Taney, Warren, these are counties that have tripled or quadrupled their populations in the last 40 years. The state of Missouri, you can see I've got there at the bottom, is positive over this period, but I think it's 0.3% or so, or rather 30% for this period. Then there's a whole bunch of counties that are in the 0 to 100% range. So 100% increase would be a doubling over that long-term period. But there are also 32 Missouri counties that have lost population over the 70 to 2019 period. The bottom among them is where I'm standing right now. The city of St. Louis has lost 50% of its population since 1970. But there are some others that have also had significant outflows. And, you know, obviously, I mean, I'm not telling anyone anything you don't know, but you would have a different approach or a different strategy if you were in a place that was having difficulty maintaining or actually losing population versus one that's very fast growing in terms of what kinds of job creation, what types of businesses are likely to be most attractive. So this is for the decade, 2010 to 2019, Missouri's total growth over the decade was 1.4%. That's not annualized, that's total over that 10-year period. And 86 counties, and I think there were 114 counties overall, 86 lost population between 2010 and 2019. Of those that increased, the growth rates slowed down quite a bit in the post-Great Recession period. And I'm sort of throwing this out. We don't know, of course, but I have at least some suspicion that we'll see even more of this in the post-COVID environment, that we're going to see slower population growth, even that we have seen in the pre-COVID era. So summing it up, and I'm very much looking forward to your questions and comments. And certainly if you see things differently than I do, I'd love to hear it. But I'm summing up the outlook for 2021 as cautious optimism for the nation and for the Missouri Main Street economy. I think that it is reasonable to expect that we could return to normal, or perhaps a new normal, whatever that means, by the end of 2021. But COVID containment is the #1 challenge. We have to get the vaccine deployed to a very large number, maybe not every person, but we do need to get, the numbers vary depending on who you hear it from, but in the 70+% range of people need to get vaccinated to be able to get COVID under control, to give businesses the confidence they need to get back to business. In terms of the Main Street economy of households and small businesses, the support from financial relief from government cannot be overstressed. If we had, and that's speak for myself, but I really don't think it's very controversial, if we had not had something like the CARES Act and all of the support provided by the Federal Reserve in terms of cutting interest rates, I do believe we would have had the worst economy since the Great Depression. Not the Great Recession, the Great Depression in the 1930s. So this has been really a tribute to how our political system can work when the chips are down. At the same time, we have to recognize many people, many businesses have been left behind. So the generally resilient performance that we've seen on Missouri Main Streets need to look now toward the post-COVID world with slower population growth, also some continuing scars, some of the harm that was done to individuals and businesses. And I think we need to think about how we're going to help take care of those folks and businesses and help them participate in the recovery, which we all hope and really want to see later this year and into next year. So I'll turn it back to Gayla and see if we have any comments and questions.
Hey, Bill, thank you. That was a lot of great information. And I know I shared earlier, I'm a numbers nerd, so I certainly appreciate the numbers, but also the stories behind the numbers. So let me change my screen. Yep, okay, great. So Bill, I do have a couple questions that have come in and comments, a couple of them excellent information. Thank you very much. So kind of the first question is, what are the shapes of these employment and consumer spending curves for those much less affected by COVID? Maybe they're working from home, or they've kept their jobs, right, or maybe they're wealthier Americans, versus those incomes and jobs that are lower or were eliminated.
Right. Yeah, that's a very interesting question. That and it really speaks to this the idea you can't paint with a broad brush everybody's experience. There are people who were able to keep their jobs. Some businesses, in fact, have flourished during this period. Certainly, internet businesses of various kinds. I think the big story there, I didn't stress it or maybe even mention it, but the big story is that there does seem to have been a change in the type of spending that people are doing. And generally, there's been a decline in the purchase of services, for the obvious ones like restaurant meals. Even though, yes, we do some takeout, still it doesn't come close to replacing the spending on in-person, in restaurant dining. So that's way down. Travel expenses, way down. All sorts of in-person experiences, entertainment of various sources, movies, concerts. So that and those types of service expenditures were especially important for people with middle and higher incomes. And those were the same people who were less affected generally, not always, but generally were able to maintain their incomes. And so what happened to that spending that didn't get done for travel, for example? Well, there's some evidence that there was a shift, a substitution. People did buy more goods, things like automobiles, but especially furniture. There was a lot of spending on home renovations. We're spending a lot more time in our homes maybe, so that might be interesting to outfit your workspace. It also seems to have encouraged people even to buy a new house, to build a new home. So those shifts in spending are important. A big question, of course, for businesses is how much of that is permanent, or will a lot of it reverse back? So, for example, restaurant dining, will we get back to the same level? One constraint is, well, many restaurants will have closed. They won't be available, or they won't know when they can safely reopen. Some of that will be replaced with new restaurant openings. So I guess that would be my comment, that I think it's an insightful question, that there's been, especially at the middle and higher end of the income spectrum, a really pretty large shift in the types of spending that people have done. And I think overall, it was not a one-for-one shift. So in other words, people didn't take their entire travel and entertainment budget and spend it, every single dollar, in buying new stuff for the house. So there was some left over, and that's what is showing up. We're seeing really remarkably high overall household saving numbers. So it appears that maybe people have more money in their bank accounts, more money in their savings accounts. And some people have talked about this. When we get to the post-COVID world, there could be kind of some pent-up spending. So maybe a surge in economic growth, surge in spending, and I think it's entirely possible.
Yeah, I spent quite a bit of my career in the hotel industry, and I know there's a lot of pent-up demand. The industry feels for travel. As soon as things are a much safer space, that there's a feeling that travel is really going to explode because people are tired of being at home and not being out and about. So good. And it'll be interesting to see once the pandemic is over and we're out of this recession or this time period, to of course go back and look at all the numbers collectively. It's hard, I'm sure, to do that midstream because we don't have all the data yet.
Right.
So next question, I don't know if you want to get into this, Bill, but this is a kind of a political. How will the continued political division affect business going forward?
Right. Of course, as we speak, there's some uncertainty. The latest I heard this morning was that one of the Senate races in Georgia, was probably going to go to the Democrat. The other was too close to call. Mm-hmm. As you say, Keith, I'm not a political scientist. I'm an economist, but I'm very interested in these issues, especially as they affect the economy. I think the conventional wisdom is that if the Democrats take both the seats in Georgia, giving them, with the vice president, the majority in the Senate, that there would be the likelihood of more spending at the federal level, not just pandemic relief, but maybe even going beyond that. For things like, say, infrastructure. And we were, Gayla and Keith, you and I were talking about broadband for not just, say, urban areas, but in rural areas. That seems to me, in some sense, has bipartisan support probably, but probably would be more likely to actually happen if it's a Democratic Senate. And then there are, of course, investments in all sorts of things, environment, that might happen. So I do know that I looked this morning, the bond market, the financial markets think that if the Democrats take both those Georgia seats and take control of the Senate, that there will be more spending. Bond yields went up pretty significantly this last night into today. As I say, the experience of the CARES Act, I think, shows that despite our partisan differences, when the situation is serious enough, we can come together to get something done. And I think that's what happened, that it was so clear, it was so obvious what was happening in February and March of this year. And it was so clear and obvious that people and businesses, the economy overall, were in great danger, that the partisan differences fell away and we got that done. And I would say no matter what happens with the races in Georgia, that would continue, that there would still be the ability under those types of circumstances to get things done, which leaves open if the circumstances are not as dire or solutions not as obvious. Do we still have gridlock? And I think the conventional wisdom, again, not a political scientist or expert, is that yeah, we still are in an era. If we have divided government, that gridlock would be probably what we should expect.
Mm-hmm. You mentioned the bond market, which pushes me to our next question. But before I get to that, I just want to remind folks we have about 9 minutes left on the webinar. So if you've got some additional questions, please feel free and get those typed in. But we had a question, Bill, about the stock market. How do you feel the stock market relates to our economy, both nationally, but also in Missouri? And do you expect the market to stay strong? I mean, it's been kind of one of those anomalies through this whole pandemic, right, that it's been a very strong stock year.
Right. Well, great question. Let me again emphasize these are my own views. The Fed does not have a view as an institution. My own view is that, and this is based on really looking at some work done by the Fed and lots of other regulatory agencies here and around the world, that what really matters for the Fed is overall financial stability. And the issue with the stock market is really the vulnerability to a big decline. And so kind of rephrasing the question, is the risk of a big stock market decline greater today than it was 6 months ago or even 12 months ago? And I think the answer is yes. And related to the idea that on standard measures, valuation measures, as well as just the way that the market has been moving, we've seen it in history that when markets get, as a previous Fed chairman, Alan Greenspan, once characterized it as frothy, and I think that's a fair characterization. The market does look frothy. The chance of a big decline, by which I mean 10, 20, 30, even as big as 50%, and we've seen that in the last few decades. We've seen that twice. The risk is higher of that. So that's I think the big concern from the perspective of the Fed. Now, it is true too that over the last several decades, the thinking within the Fed has, I would say, drawn a distinction between a housing market, if you want to call it a bubble or froth or overvaluation, and a stock market bubble or frothiness. Our thinking has been that the housing market is much more dangerous, and we saw that in 2008, 2009, because for a couple of reasons. One, because housing is so much more broadly held. Roughly two-thirds of households are homeowners, so declines in value affect a much broader scope, whereas in the stock market, only the very high income, high wealth families have a very substantial holding. So declines in house prices affect many more families, including those who are less financially strong, whereas the stock market decline mostly affects very wealthy people and probably will not have that much of an effect on, say, on consumer spending. The other distinction is that housing is much more often supported by debt, that is mortgage debt. About two-thirds of homeowners have a mortgage. Whereas in the stock market, although there are a few investors have margin loans, that's much less of a concern. So it's the combination of the widespread holding of housing, the leveraged positions, the debt behind it, that make housing declines much more dangerous. So that is a source of comfort, I think, right now from the Fed's perspective, that we do not, never say never, but we don't believe that there's a housing market issue. We really do not anticipate big declines in house prices, whereas in the stock market, it seems much more likely that there could be a big decline. The good thing about it is that we would think it would be less disruptive. It would have more effect on wealthier people, potentially could affect businesses. But again, probably more the larger businesses that have publicly traded stock. So I guess I would summarize it by saying I don't think that the stock market is a major concern from the Fed's perspective, but it's certainly it's on the radar, and the what seems to be a heightened risk of a big decline, or call it whatever you will, a correction or a pullback, could be disruptive. And so if, for example, this scenario I mentioned, that we're in a double dip recession in the first quarter of this year, employment growth is declining, or employment's declining, consumer spending is down, and then you got a big stock market decline at the same time, that would be perhaps a little bit more of a worry. And I think also, and again, speaking only for myself, there is a concern among some people that the Fed is really not in a position to do very much at this point. Interest rates are already at zero, can't cut them any further, and the asset purchases are already going pretty much at full steam. It seems that adding more to that purchase activity wouldn't do very much. So that's also maybe a little bit of a source of a vulnerability, that the Fed really couldn't do much, even if there were some financial upsets.
Okay, great. I have a couple questions related to population, so I'm going to kind of put them all together. In fact, it's one of the things I wrote down also. So have you seen any stats or population movement between states? You kind of showcased Illinois a little bit, and we talked before the webinar that we're seeing some migration from Illinois into Missouri on the east side of the state. But have you seen those numbers? And then related to that, we've got a declining birth rates, aging population. How is that going to affect the job market? Many businesses were struggling to find employees before the pandemic, and now people are leaving the job market. Unfortunately, folks are dying, and people are moving out of city centers. Or I guess that's kind of related too. Are you seeing numbers of people moving out of those city centers into more rural areas? And so just kind of talk a little bit more about the population.
Yeah, there's a lot of interesting information from the Census Bureau that actually does track people leaving Area A and moving to Area B. And yeah, it's places like Illinois. Also, California is losing, not on the same scale, but New York, New Jersey. Yeah, there's over many years that has been true. People have been leaving the upper Midwest generally, moving to the Sun Belt, and the more expensive coastal areas. Chronically, New York, for example, has lost population over a number of years. So yeah, that data is available. I showed a couple of pictures just to kind of give us a local, very perfect illustration of that Illinois is losing population. And as I said, that dynamic of having a declining population is something that most of us don't have much experience with, or maybe you do in your local area. And without being too alarmist, I think it is a big deal, because it sets in motion some issues, not least the tax revenue, but also think about the housing market. If your population is shrinking, how much incentive is there to build new housing? Not much. And so that then over time leads to a less attractive housing stock. So maybe it makes it a little bit more difficult even to attract people. So I guess my point is that it can kind of feed on itself. Now, there's not a lot we can do about the birth rate. Maybe the dimension on which we have a little bit of control is this inflow and outflow, the migration patterns. And so I think that's, my perception is that's kind of what Missouri Main Street is about, is you're trying to come up with ways for communities to make themselves attractive for people to stay in those communities, but also even to draw in new people. And that's really the point of why I wanted to add this, that discussion, is that, it's possible to be kind of fatalistic and pessimistic and saying, oh, there's nothing we can do. And to a large extent, there are forces beyond our control. But the things we can control, I think, are, our local environment and making it attractive. That's the business climate. And of course, that's probably more of an issue at the state level and the federal level, but especially state. But just the local the amenities, the community itself. I think, and you see that the differences across the state, that some areas are attracting population, even when the state overall is not growing to much an extent.
Yeah.
Some of that's, of course, within the state migration, but some of it is people coming from out of the state.
Great, great. Well, Bill, that's the end of our questions. I want to thank you, and I'm going to reinforce that point you just made. Our last speaker in December was Jim Thompson, and he's the economic vitality specialist for Iowa Main Street, and we bring him to Missouri quite a bit, and it comes down to that housing issue. As communities, you've got to figure out what housing you have at what price points, and make yourself attractive, and that is where Main Street comes in with its principles and philosophies to help make that happen. So I appreciate you reinforcing that message. That was perfect. Bill, thank you very much. Appreciated the information. As I've said before, I'm a numbers nerd, and I really appreciated what you presented. But then it's the analysis and the story behind those numbers that really give credibility to what we're looking at, and also help us make decisions in our own local community. So I certainly appreciate that.
Thanks, Keith.
I'm going to do a quick commercial. Our February 3rd Mornings on Main webinar will be on business incubators and pop-up shops. So how do we continue to prime the pump with our business recruitment and retention efforts? We're going to have a couple Main Street directors and folks related to communities that are using these to help their business climate, and help those folks that are leaving that job market that want to start their own business. So it'll be a great follow-up to today's presentation. So we appreciate it. Everybody have a happy new year. Bill, again, thank you very much, and we'll see you guys next month.
Thanks, Keith. Thanks, Gayla.
Bye-bye.